Welcome back, investor. We have a guest I'm very excited to have on today. It's Shane Pogue with AEGIS Risk Solutions and Investigations. And Shane, if you've been on LinkedIn any length of time, you've seen him posting about like fraud and scam alerts. And so he does due diligence and different kinds of investigations for anywhere from the passive investor, consumer, which most of you listening would be, but all the way up to different kinds of businesses and family offices to help them vet out the operator that they're investing with or the company itself. And it's such an important topic. I feel like so many people don't want to talk about the possibility for fraud and scam because it might be negative and it might make nervous investors and things. But I feel like nervous investors are going to be nervous because they know that they don't know things. And so empowering people with that knowledge is something that I really like to do on the show. So if you've been listening for any length of time, maybe once a year or twice a year, I like to have somebody on who's either been a victim of some sort of financial crime, a perpetrator maybe has gone to prison, that redemption arc story. We've had a few on there that have become investigators. And Shane coming on today to just talk about like the red flags that you need to watch out for, common tactics. And then also I really want to get into the side of understanding that the risk management is not so that you can protect yourself so much that they'll never do a deal because that costs more money than getting scammed. And so being able to at a certain point let go, chalk up losses, and the psychology of recovering from that and continuing to invest for a net win, I think is really important from investor psychology standpoint. And the people who understand psychology may be the ones who are trying to rip you off. And so we want to come in on the other side and help you understand your own psychology so that you can benefit the most that you possibly can from investing in private securities and private markets and things like that. So super excited to have Shane on today. Welcome to the show, Shane.
Yeah, thanks for having me on.
Yeah, can you tell us a little bit about yourself, just your background, your credibility on how you got into this and what led you to it, but then also your special set of skills that you bring into what it is that you do?
Gotcha. So I have kind of a bit of a crazy story. I've never really wanted to be in the finance world at all. That might be really funny to say for someone that's so into it right now and had like founded a company specifically in the finance world. But my original life plan was to actually be a police officer.
Okay.
I went to college with a criminal justice degree, and then after I graduated, I joined the Army through a pilot program to become one of their criminal investigation division agents. After enlisting, I was planning on doing that for like 10 years or so. I think my contract was actually 12 years, but a couple of them were reserve years.
Mhm.
So I was planning on being in the public service space for a very long time. Unfortunately, I got discharged from the Army with a heart condition.
Mm.
Didn't really know what I was going to do there. And then luckily I have an absolutely amazing wife. She knew what I wanted to do with my life, and she found an opening at a private investigation agency it wasn't really the role I would want her to do, but that's where she pushed me there. And then they gave me a better job than the one I had applied for. So I got really lucky there. Um, and then from there, I actually didn't go into the financial space until I started working for Fidelity Investments. And I started out working at the background investigations department and eventually moved into their due diligence department. And that kind of led me to where I am today a little bit, but that's more of my present story. It has been about 2 years since I launched my own company, but the idea was just I was looking out into private equity and saw that a lot of people didn't have the protections that big institutional investors just kind of took
Mm.
for granted. And it was causing all sorts of problems. They were getting into scams that were very easily avoidable. I think you were talking about it earlier. There was a guy that he seems to be fairly smart on the markets and the kind of questions you need to ask. And he says, I spotted a fraud in 3 questions.
Yeah.
And that's the kind of support I give to my clients too. It's not always these big long reports on these on potential investments that lay out all the risks. Sometimes it's me asking them very simple questions about something, and then that like kind of thing clicking in their head, and they're going, "Oh, okay. I don't know if this is something I'm actually interested in anymore." Before we ever even start anything.
Yeah. No, so pretty heavy hitting background coming in from the criminal investigation, but then also with Fidelity and getting into the financial side of things. So that kind of builds your credibility. I see behind you, you've got a University of North Texas diploma on your wall. Can you tell us a little bit more about that?
Yes. So I went to school for a degree in criminal justice, had a very big focus on like CSI type stuff as well.
Hmm.
That's what the other thing on the wall is. It's the certificate in criminalistics. It basically just means if you are a CSI and you start talking to me, I won't be completely lost. So it's basically like it's like one step below an associate's degree.
Okay, like a certificate.
Uh, Absolutely. And then there was a big emphasis, expecting and I think this is really helpful for my work in the criminal investigation part of my degree, on actually looking into patterns of behavior, because that's where you usually catch people doing things that they're not supposed to, is like over time. It's very, very hard to change who you are as a person. It, and if you don't want to intentionally do it, it will never happen. So if you track those patterns of behaviors over a long period of time, say 10 years, you can actually start to find all sorts of crazy things.
Okay. Yeah, and I think that the people who commit the most fraud are the ones who go into a situation without any intention to commit fraud, and something goes wrong in the investment, and then they start trying to cover it up because I can fix it. I don't have to tell anybody, but then when
Mhm.
it's fixed, then I won't have to tell anybody because I fixed it. So we probably don't see a lot of that kind of activity because they do fix it and it does never come to public light. We had a guest on a couple of years ago who he did this trying to fix his error for 10 years until he finally turned himself in because he realized
Mhm.
he was so stressed out about getting caught on his financial audits that he finally turned himself in. And he did get sentenced and did 10 years in prison. And when he came out, he said that it would never have come to light if he hadn't turned himself in. And he was shocked every time he would pass an audit and these types of things. And I think that that's the kind of person that we need to be most concerned about. And he's like, there are very few like psychological markers that you
Mhm.
can look at, or so this person's going to scam you and this person's not. And so that's the one that scares me the most, is the person who is the well-meaning cover upper to try and fix their problems. So I guess given that is the most likely way we're going to get scammed is through that incompetence angle. Can you give us some of the top things that you look for, like the first time you talk with an investor, what your services look like, and maybe like for the purpose of the podcast is to kind of give the DIY version and when they know that they need to pull in somebody like you to protect them from making a mistake.
Ooh, I'm for part of it. I'm gonna have to give you the lawyer's favorite answer. It depends.
Yeah.
But one of the first thing I'm looking for on a client is fit, because this is so important. Probably more than anything, it doesn't matter if you're doing investments or if you're doing due diligence and risk management for people. You got to have that fit, because if I'm trying to hard sell this guy on something, even if he's interested,
Hmm.
at the end of the day, everything I do for him is going to be a little bit skeptical, and it's going to be harder for him to do whatever he needs to do. So he'll get this big long report that might tell him, "Hey, this investment might be higher risk than you originally thought." Well, if I had to hard sell him and I just barely got it through the gate, he's not going to take that at face value, and he might actually go and invest in something that's way outside of his risk profile,
Okay.
even though you're sitting there and you're like, okay, yeah, I kind of explained that. Um, yeah, but what was the second question again? I want to make sure I'm being very clear on it.
Yeah, yeah. Sometimes I ask more than one question at a time because I get so excited. But yeah, just kind of the big risk factors that the DIY person can look at, and they can, because you have to start out doing your own screening, right? And so you're
Mhm.
asking questions, and they can probably eliminate certain things before they ever call you in. So, what are the DIY things they should be asking themselves? And then, at what point in an investment will they say, "I need a second opinion on this," and call you in? So, just kind of start out that DIY stuff, and then at what point you usually are best to step in.
Well, one, the DIY stuff is going to be almost all on you. I do have
Mhm.
an investor due diligence guide up on my LinkedIn page that anyone can go view. It just tells you the basic steps to run through. But at the end of the day, you need to know what your own risk profile is. You need to set it in stone. You don't need to like adjust it based on the whatever different opportunity comes your way. You need to know what you're investing in. And then you need to put that on paper. And when something doesn't pass through your criteria, don't even involve someone like me. Just say no and keep it at that. Don't let someone convince you to invest in something you don't understand. Don't let people do things like that. Just stick to your guns and make sure you're following your own criteria first. And then you can involve someone like me that's going to go through and do all the detail work.
How does somebody figure out what their risk profile is? Because I know with my own investing, when we very first started out, my husband had a good W-2 and I said, "Hey, it's your job to keep the lights on. I'm going to go out here. I don't need to pull any income from this investing business. I can just reinvest all the gains. I can absorb the losses without impacting the family." And
Mhm,
so I was very growth mindset and my risk profile was much higher. And then as we got closer to the point where I'm like, "Hey, I think we can actually retire my husband. We're going to lose that W-2 income." I started to get much more concerned about cash flow. And then now as our
mhm,
cash flow situation is kind of ironing back out, I'm much more concerned about wealth preservation. But I
mhm,
can kind of in a future where I might get back to that high growth mindset because all of this foundational stuff is taken care of and we'll have like the W-2 income took care of everything. And then I can be really risky with the extra money. So I'm tracking like my own risk profile, my own risk tolerance, and my own journey. And it's definitely changing. So how could somebody identify what their because people say like, oh, how you invest depends on what your goals are. And at the beginning, I was like, I mean, what are my goals? Become really rich. Like it's so vague. So how can somebody identify their own risk profile, especially given that it changes so much over time?
Well, a good way to actually do that is to describe different types of investments and the risks to yourself. So, for example, let's say multifamily syndication deal. You don't have it's passive, a true passive investment. You don't have any control over what goes on at the apartment complex. You're basically either basically relying on faith or getting someone like me to come in there and vet the syndicator for you to make sure that they're doing everything they're supposed to, their portfolio is not water, things like that. So if you describe that situation to an investor and they say, "Oh, that sounds fine to me," they probably have like a medium to high risk profile. Um, and most people would probably get a little bit antsy about that because they're like, syndications are fine. Syndications are great, but they are kind of a higher risk investment.
Mhm.
If you're like me, you're probably like, I like stocks, bonds, things like that. Very low risk profile stuff. That's my personality. It's not any kind of recommendation on my part where like, oh no, it's unsafe to invest in these private equity markets. That's just where I'm at as a person right now. So it's just a little bit of a different thing. It's like you need to realize, hey, my investment, I like these investments because I feel like they give me the best value. And then you need to go from there because if you're looking at isn't just a general mindset of, oh, what's my risk profile? What's my goals? You're probably going to miss the mark because you're not using specific examples. You're going, hey, in general, what are my goals? Well, I'd like to make a lot of money. Well,
Yeah.
so does everyone. But that might not be helpful, but if you're like at retirement age, you're not looking to make a ton of money. You're looking to either build your nest egg or keep it kind of even so that you don't have to go out and get a second retirement job.
Mhm. Yeah, definitely. Oh, I it I don't know if people can really understand it till they start to go through it themselves, because I don't know if I understood it. I wanted somebody to lay it out, like, how much money you have coming in and how much money you have invested usually kind of determines your risk profile. If you
Mhm,
hardly make any money, then you're gonna be pretty low risk, but if you're making a lot of money, but you don't have that much invested, you might be more growth mindset oriented. And so I think people sometimes get their this is where they get into the scams is that their eyes start to light up when they see high returns and they don't understand the risk that often comes with those higher returns. I mean, I'll give you an example.
yep.
You could just put money in the S&P 500. That is the gold
Mhm,
star benchmark and index funds became a thing, whenever I don't know in the 80s, Vanguard. And I feel like before that, we didn't have that kind of benchmark. We didn't have that kind of financial data to back up like this just seems to keep outperforming year after year after year. And we don't have that in private markets yet. And so the set it and forget it, low risk, just stick it in an index fund is so easy for us to do with modern investing
mhm,
technology. And while we're developing that in the private market world, it's like you have to do more work. You're taking on more risk. The returns need to be higher because this over here, this index fund is the easy button. Literally you could just put it in there and set it and forget it. And yet over here, it's so much more complicated. It takes more front end work. those companies have not been evaluated for a public offerings, the asset tests, the asset valuations just are not there. And so understanding that that amount of risk and that amount of extra work to up your self-directed IRA or to set up your accounts or your tax situation, it becomes more complicated and more expensive, and you're going to pay higher fees as well. And so it's like, yeah, you have to have a higher return to justify that additional
Yep.
work and risk.
No, I mean, I actually work with lenders too, and it's the same lending space. Your interest rate's going to go up the higher risk you are.
Yeah.
So if you're a very low risk person, your interest rate's probably going to be fairly reasonable. If you have a highly leveraged portfolio and all these different issues in the back, your interest rate's probably going to go up, especially if you're working with a lender that specializes in distressed deals or something. Um,
Mhm.
same thing with investments. If you're taking a lot of risk, you're putting a lot of money into it, and you're basically relying on something that might not be a sure bet, which nothing ever is. But
Yeah. Not even the S&P, but you're
yeah,
unlikely to lose more than
not
like
even
10.
stocks and bonds are a sure bet. There's all kinds of problems. And if someone does tell you that something is a sure bet, that's a pretty big red flag that you want to kind of walk away from there.
Yeah, and kind of illegal too. You can't really guarantee
Yeah.
returns or say sure bets or any of that. And I guess the thing is like people see those higher returns, they get excited about it, but yet they don't understand the increased risk trade-off that comes with those higher returns and the higher level of due diligence that they're responsible to do. Do you see that? Do people bring you things that they're like, oh, this is a da, da," they get all excited about these high returns and you're like, "Ooh."
All the time. I try. All it is honestly some of the stuff that come across my desk sometimes is absolutely crazy. I built a list out for everything we looked into last year, and this just there are so many opportunities in private markets that having someone that's just like, hey, a due diligence generalist that was like, I don't specialize in underwriting, I don't specialize in the risk management side where I'm sitting there with like a calculator and being like, "Ooh, with these numbers, this is going to work like this," and doing all these algorithms. I'm a due diligence generalist. So if you bring me, say, a film investment, I'm going to look at it through the lens of a person that, hey, how is this going to work? Practically, how do films work as businesses? How do you make money off of them? If you're going to invest in this film, how are you going to get money back? Is that realistic compared to what we should expect in that industry? What is what is the actual sponsor of or the director or whoever's raising money for the film actually saying? And that's just a off pure example because it's one of the more crazy areas where we did due diligence last year.
Yeah. Oh, yes. And there are just so many ways that some of this stuff can go wrong. But at the same time, I like the fact that you're talking about being a generalist because like my husband used to do startup IT, and one of the criticisms that he got in his career is like, you're not really good at any one particular thing, so we can't really pay you like a rock star because
Mhm.
you don't do anything rock star like. And he sat back and he's like, no, I'm a rock star at your startup because I can do this is you get one guy who can do all these things. And then I can hire specialists as the company grows. I can help hire and spin off these departments as the company grows. And he realized over time, he's like, I really am like a startup specialist. And so generalism can sometimes be a specialty because you know where your boundaries are and you know when you need to call in somebody who is a specialist in this particular area. You're kind of like the family doctor. And you're like,
Mhm.
hey, I need to send you out to this particular special doctor. But you may be able to do it all in house like a family doctor can. So I think that there's a huge value for that type of person in any profession. And I don't know a whole lot of them that are in the general area. They're like financial auditors or whatnot. So I don't know. Can you tell me like what you're looking at? Because you're looking at a diverse group of things. We focus mostly on real estate in our own personal portfolio. So the podcast really tends that direction. So
Mhm.
let's look at this through like a real estate lens. What types of things are you looking for when somebody first brings you a deal that are you looking more at the operator, their background history, the strength of their portfolio, the financials of the specific deal? Like, and at what point do you say this is where I end, and where if you want to continue, I recommend a specialist, or no, I think that we can do all this in house.
Um, definitely depends on the deal whether or not I'd recommend doing everything in house. Because occasionally you would benefit from bringing in like a rock star underwriter, someone like that. That's all they do all day long. And I have recommendations if someone goes there and they're like, "Hey, I'm spending a ton of money on this deal, I want to make sure that it's underwritten to the best ability possible.
Mhm.
I have people that come up. For me, I look at a bit of everything. So we're looking at the sponsor's history. We're looking at their track record down to the property record level, confirming sales, things like that. Looking at their actual marketing materials, making sure their IRRs are realistic, making sure that if they're making claims, they're in line with all compliance standard, regulatory standards, everything there. Sometimes people's biggest red flags are it's their own marketing materials and their websites.
Okay.
Like I've gone through them a couple times and from very big companies and said, and just went, you can't say this. If the FCC looks at this webpage, they're going to start investigating you immediately.
Oh boy. What are those things though? Like what do you see like in the first line when you're going into something that you're just gonna say, okay, these things are an automatic boot. What are some of those things?
Uh, Absolutely crazy returns. I've seen up to 130% returns on advertised on websites, not as disclaimers or as past performance, but just as no disclaimer, just, hey, yeah, you can get like 130%, or they start going up into like the 50s. And you're like, the only way this is a syndication deal. The only way you're getting that is if this guy is just the best syndicator in the entire world. That's just not going to happen most of the time. And you need to be realistic because there's actual language where you say something explicitly, and then there's implied language. So if you put that IRR on your website and all of your IRRs are like that, you start to imply that all your IRRs are going to be high. And then at the very bottom of your pitch deck, you said past performance isn't indicative of our future performance. And then, well, that investor might not have read through the whole pitch deck, or they might not have read through the whole offering memorandum. And that does happen. I've had some crazy ones where I read through the whole thing and I'm like, this actually said that they don't have any obligation to buy a property with the money they raise, and they can use the money whenever they want. That's a bit of a red flag for me. That language is included in some memorandums, and it's not really odd. But when I told that to the investor, they were like, "That is absolutely crazy."
Yeah. Oh, if okay, so let's look at the legal documents and disclosures. They're I have two questions, but I'm going to try and ask them one at a time. First thing would be sometimes I'm required to sign a non-disclosure agreement to get access to these documents. Obviously, I could share them with somebody like you because you're my representative.
Mhm.
But because my lawyer or my certified public accountant don't really need to sign their own NDA because their certifications protect them. Would you need to come in on a written NDA to access some of those materials?
It depends on the different arrangement. So, when I'm working in the venture capital space, I almost always have to sign an NDA myself. But we're already on, me and my clients are already on NDA. And specifically my subscription clients is really where we get into the whole risk management part. We already have an NDA running, so I can't disclose any part of your deal. If you see like a case study of mine on my LinkedIn page or whatever, a lot of the details have actually been changed so that no one can be identified. Um, they're also approved by clients, and usually they come from our actual different line of business than subscription services.
Mhm.
So we definitely yeah, in most cases, I would need to sign an NDA if it would be legally dubious for you to not have me sign one. But
Okay.
in some cases, the information they're providing is easily accessible. For example, I think I was reviewing a syndicator last year where my client was asking me if I needed to sign an NDA on it. And I was like, I can, I can view this online.
Yeah.
Like this is public information. I don't need to sign an NDA. A lot of people forget that some of the links you put in your webpage, if you don't have your webpage coded correctly, you can actually access those as a third party by just typing in the address.
Yeah. And if you can kind of guess, like in
Yeah.
slash and or whatnot. Well, okay, that brings me to another question about security. When I mean, I have a workspace for a more secure workspace that I pay
Mm,
for, right? Like that has a large language model included in it so that I know that I have certain protections that I can analyze these confidential documents without violating my NDA. And, we set it up in a certain way. But for the average investor who's not an institutional or they're just a retail investor, sometimes they are not using good security practices, especially like when you're talking about like wiring funds and they start talking about all these
mm.
things and then they start to become the victim. These kinds of scams are like almost like the secondary scams that I think of where somebody sent their money to the wrong place because somebody got into their unsecured Gmail or whatever
Mhm.
accounts, fraudulent wire instructions. It happened to a buddy of mine. It's like 2 years ago. I'm like, aren't we past the days of sending your wire to the wrong, wrong place?
Yes.
But I mean, those types of security things, like what should a basic person have in place before they start talking about investments with multiple zeros at the end of it?
Um, I would definitely learn how to encrypt an email.
Okay.
Uh, Outlook can do it itself. It's a feature in Outlook. You can encrypt emails in Outlook. It is very important if you're sending wire instructions or something like that. Also, if you're sending wire instructions to someone, always double confirm. Honestly, I would triple confirm, but email, if you're sending a third email, that's okay. But also you need to call the other party and make sure the instructions are correct. That's very basic wire transfer practices.
Hmm.
And do not take the email phone number and call that number just in case the email was breached. You call the known phone number of the person through their
Yes.
like website, or you call that the number you have in your contacts. If they suddenly go, "Oh, I changed my number," it's like, well, I'm not transferring this wire instruction until we can do some confirmation.
Yes. Yes. Oh man. Um, The other thing is I've noticed in real estate, the threat from the competition is not such a big deal to most real estate syndicators, especially once they have the property under contract already.
Mm.
Usually before the NDAs, while they just have it under letter of intent, they don't really have it under control. They'll make you sign. But what I've noticed in like venture capital, wow, that's a much different because you have competition threat where their NDAs are much more strict about not releasing this and they make everybody sign one. So are there additional security concerns somebody would have if they have an NDA to evaluate a business that could have serious competition if any of this information got out, emails or even their workspaces or their large language models where they're analyzing the documents they got? Because oftentimes they're above our heads and we need a little help from the AI to be able to parse through all of the data.
Yes, you definitely want to be a little bit more careful when you get into a situation like that. For like a syndicator, honestly, most of their data isn't that important. It might be like important for like a small period of time, like 3 months when they try to get the deal. Um, But when you get into the venture capital space, pretty much everything they have in their deal rooms is going to be very high security. You want to treat it very
Mhm.
carefully. You don't want to send it to unauthorized parties. If you're sending it to someone like me, you probably want to let them know about it beforehand to make sure you don't have the, like, I don't have to sign an NDA, which I'll happily do if it's relevant to the deal. A lot of the times I come in from a discrete location. So like, you don't necessarily have to tell someone I'm doing what I'm doing. But when NDAs are involved, I like to get involved because let's say we have a startup founder and we're in the venture capital space and I want to evaluate that founder. Sometimes they can actually answer questions that are helpful to the due diligence process if I have direct access to them.
Okay.
And it's a very different process when you're evaluating a startup founder than when you're evaluating like a syndicate. You're not just evaluating them as a person. You never are just evaluating the person. You're always evaluating the deal. You're evaluating how realistic it is. You're evaluating the market. You're evaluating all these different things. So when you have that person and maybe the person's the problem in that situation. Yeah, for example, I might find a legal case that would more or less preclude some investors from even considering this. Well, if I get information from the founder that is not public knowledge. It might be some sort of filing and that's coming into the case that's not publicly available yet. Uh, we don't have public court access to it. We go through and we verify that an issue that was high risk is now a low risk issue because the case is completely settled. There's
Mhm.
no, there's no admission of guilt, nothing like that. it does change the factor. And if it's an isolated incident, this is where it goes back to how patterns of behavior. If it's an isolated incident, this legal case that might be high risk, we can actually lower the whole risk profile of this investment, because what we thought might be an indicator of fraud is actually a settled issue.
Okay. Yeah. And that I see that happening is like, what's the saying? If you're not getting sued, you're not doing a big enough business or something like that. You're not trying
Yep.
hard enough. And so just being sued or having complaints is not necessarily a red flag. I mean, to me it is. I'd be one of those people, if I got sued, I would probably just come, fall to pieces. I'm super careful that way, but and I don't like to get involved in things where somebody might want to sue me, but I do know a lot of businesses where people see a big target on your back and it comes out, and it's not always as big a deal as you think it is. And sometimes like a legal encumbrance on a property ends up being a nothing. But when I first see it, I'm like, oh, so you're able to kind of comb through those and see which of these are problematic and a pattern of behavior, admissions of guilt, things like that, versus things that are like, this was somebody complaining and they settled it. And I don't think this is a risk factor.
Mhm.
Yeah. Okay. So let's talk about a little bit about the documents that people do need to read. So we talked a little bit about making sure that your environment is secure, not just who you reveal the information to, but also that you're not analyzing these documents in a digitally insecure place. So make sure that your workspace, your digital workspace is secure. Make sure that your people are secure. But you get all these documents through. And a lot of people they're not gonna read all that. So how much does somebody really need to read every word of every 150-page PPM that they get sent? I mean, I know what my answer is, but I'm curious to hear what you say.
My answer is probably very similar to yours. I think you should read it. Even
Yeah.
if you don't understand everything, you need to read it. It's going to suck. But at the end of the day, if you're putting a lot of money into a deal, you need to put a lot of effort into it as well. That could mean hiring someone like me to help you look through documents, but sometimes but a lot of the times you've got to take personal responsibility for it. Because, for example, let's say you didn't hire me, you hired a different due diligence firm and they do quick stuff that's all outsourced to some other country and all their people are overworked. They're not going to review documents for you. They absolutely will not. So you need to be very careful about that and review them yourself, so that you're protected, because it's not industry standard. I kind of like to break from industry standards and due diligence because it causes problems, especially when investors aren't going and reading all their documents. If you don't say, hey, yeah, I'll help you read through documents, you expose them to risks that they didn't need to be exposed to.
Okay. Yeah. So that I say it on the show. We had somebody on recently where I just had to like get right in the camera and be like, you cannot abdicate your financial responsibility for your own portfolio. You cannot hire people to do everything
Mm.
for you. I feel like there's a certain amount, if you want to be in private markets, maybe even public, but private markets especially, you have to accept a certain amount of self-education and some work that you need to do. Is that, I don't know if you've ever thought about this before. I often tell people who are getting into private markets that you are going to spend some money on due diligence and that you should expect to, if you're going to put in 50, 100,000, $1 million, you're going to expect to spend some money to vet out this opportunity. It's almost like if you don't, you're stepping over dollars to pick up pennies. You're trying to save money on the due diligence expenses. But then you may pay more on the other end if the investment was something you could have avoided. Some of it's unavoidable, and that's the psychology of just kind of getting ready for that. But a lot of it is avoidable if you just do the proper due diligence on the front end and reject deals before you get into them. Um, what can somebody expect to spend reasonably? And can you say like for every $50,000 they invest, they should expect to spend X on due diligence?
Oh yeah, there's actually an exact percentage number. Well,
Okay.
not an exact, but it's a range.
Some thought about
It's usually 2 to 5% of whatever you're spending. It should be used solely on due diligence.
it. Okay.
Whatever you're investing, the idea is that that's why it's not an exact number. The idea is that the due diligence should be equivalent to the actual investment size, not and proportional, so that if you're doing a big deal, the due diligence rates go up. You're bringing in more people. So You might bring in someone like me. You might bring in an expert underwriter. You might bring in, bring in your lawyer for several document reviews, things that you need to do if you're spending lots of money. If you're making a $10,000 investment, maybe it makes sense to bring in someone like me is more of a generalist and could do a bunch of different things. But yeah, it's just, you want to do about 2 to 5%. And in certain cases, you might even want to go more than that if you realize right off the bat, it's going to be a higher deal.
Okay. And I think that the 2% versus the 5% doesn't just matter the size of the deal. It also matters the percent of your personal wealth that's going into that deal. Because if $50,000 to a billionaire is like, they're not even going to bother. They're just like, do
Mm,
that. Right. But I have one investor who says, I don't ever put less than 250 somewhere because of the management headache of tracking it all. And so because it's a certain portion of his net worth that he's decided that he's only going to deploy
mm,
it in these amounts. And so he would be spending a different amount on due diligence than somebody who like him with the same net worth if they're putting $50,000 into a deal. And so the percentage of net worth I think is important to step back and think about before they deploy any money at all. What percentage of your net worth is this? And have they done the bucket work of how much am I going to put in real estate? How much am I going to put in venture capital? How much am I going to put, even just public versus private markets? All of those kinds of questions have to be answered. And I guess that's your risk tolerance. Uh, this
yep.
kind of this back to the beginning. It's
That's
like,
a big part of it involved.
yeah, your investor profile is like, how do you want your portfolio to look? And does this deal violate that original question, like what you were asking on the questionnaire or the form that they fill out to kind of figure themselves out before they start diving into this. So budgeting for due diligence, super important. When we're doing, say, a multifamily acquisition, due diligence is a line item. And it's usually,
Mm,
rule of thumb is like a percentage. We start with that. And then we actually start getting quotes in from the people who are going to do the work for us. And then we can give that a more exact number. But it is starting out with just a percentage of the total budget. And we just expect to spend that. And it would be irresponsible if we didn't spend that. Yet
mm,
some of the people who want to invest are not willing to line item that same due diligence cost. And it's so, so important that you get somebody in there that can help you fulfill your obligation so you don't completely abdicate, but you might need some help. So there's a balance
yep.
there, and read your docs. Let's talk about, as we're kind of wrapping up here, the psychology of the investor and understanding themselves and how to recover financially and emotionally when there is, and I hate to say inevitable loss, but probably an inevitable loss. We all lose money on stuff. Sometimes there's been no scam, no fraud, and no incompetence. It's just this one didn't work out. It happens. It happens to the best operators. There's no legal liability. It's just it happened. So how can people start to recover from that? Because you could probably see people coming to you who have been burned and are very, very nervous. And they're just having a hard time getting over that hump to get back into the game. The fact that they're even considering it by coming to you is a good sign. But how do you kind of coach people through that psychological recovery?
Honestly, I try to give them the information they need to make sound decisions. And I let them know that, like, hey, things are going to go bad sometimes. There's nothing you can do about it. And if you sit on the sidelines, it's just going to stay the same.
Yeah.
There's nothing, you can't do anything about a deal that goes bad for more or less no reason. And honestly, there's some really crazy examples I have of deals that have gone bad for very obvious reasons, but the reasons were not controllable. For example, I was, one of my actual clients, they had the roof blow off their syndication during a hurricane, the entire roof set them back so much. They had to do a capital call, everything. It wasn't even like a big name syndication or anything like that. It's just the roof blew off. And it's like, that's one of the things that happens. Like, yeah, people lost money on that deal because of something no one could control. And that's kind of the big, like, hey, yeah, there stuff happens and you can't always plan for it type of thing I try to tell people. And sometimes it's not, oh, a roof blew up. Sometimes it's, hey, you guys thought you were getting a great deal in a great market and you didn't have all the data right away because the data wasn't there to have.
Hmm.
And then suddenly the deal starts going bad and you don't know what to do and everything goes and everyone loses their money, including the sponsor. And there's just nothing you can do about it because there's no legal liability there. If there's no fraud, they did what they were trying to do. There is no like indicators that they were being a bad operator. It just went bad.
Yeah. I mean, I heard a story from one of my guests a couple of years ago that they were across the river from the main amenity that they were buying this building to access, and the city took the bridge down. It's like- and it wasn't something that was planned when they bought the thing. And he said that alone wouldn't have taken the deal down. However, there were 2 or 3 other little things that
Mhm.
also couldn't take the deal down, but together the 3 things kind of had a compounding impact and took the deal down. I believe that one was a total loss to the investors. I think they lost their property, but I feel like it's never just one thing. It's always like a collection of death by a thousand cuts type of thing. Alone or even in concert, they're not going to do it. But you get enough of those, and eventually,
Mhm.
some of them are controllable, some of them aren't. But the net effect is the same. People lose money, and then they don't want to get in the game again, especially right now, multifamily specifically. People call it a correction. I'm like, it's a little bubbly looking to me. Like I think it was a bubble,
Mhm.
but I want to think that there's more pain to come because all of the stabilized loans that we got in like 2020, 2021, but that had 5-year terms are coming due. And we had a building that we just sold because we were looking at this impending refinance, and we're like, that new higher interest rate on this beautiful stabilized agency loan that we have, that's
Mhm.
gone away, and I don't wanna operate a property with those new margins, on that kind of loan, and so we sold it, and I think that we weren't necessarily distressed because we were kind of looking out in the future, and we were able to sell
Mhm.
it in a market that was still offering decent, cap rates, but I'm really concerned about what I see coming up with all the people who are gonna be losing money when those stabilized properties need to refinance. It'd be a great buying opportunity because I think that it
Mhm.
will increase cap rates. But I feel like the sellers and their investors are going to be in some trouble. I don't think that this is over yet. And people are feeling already very burned. Distributions have paused. They've had several that have lost their entire investment, foreclosure, or they had to sell basically at an investor loss of capital. This stuff is happening and people are feeling very burned. But yet we're saying there's going to be a big buying opportunity coming up. Get ready to invest. And they're like, I don't, I don't think so. To me, it almost seems like you lost money and you have no plan to benefit from the same calamity that caused you to lose money. If I lost money in this calamity, you can bet I'm gonna make money on the other. I'm gonna make mine back by taking advantage of the same situation that caused me to lose money. And that's my approach to it. But I don't know. I mean, not everybody is the same. So what do you see that helps people to be able to let go and step in again?
Uh, Information's a big part of it. We want to make sure that they actually have, because well, I hear almost the same story for every investor that I work with.
Mhm.
Essentially, they didn't have access to someone like me before, so they were doing their own due diligence, which is it's not even only dangerous from the factor that you miss stuff. One of the things that you actually have to train people out of when they're doing due diligence is accidentally coming up with issues that don't exist. Because
Okay.
they'll actually, and it happens a lot, especially when you're investigating fraud, is you start to form patterns in your head that might not actually be there on paper. So you always have to have a second set of eyes on it and go, hey, is this something actually here, or is it something I'm imagining because of these different factors? Because there's a lot of psychology that goes into analyzing different stuff, and you want to make sure that your own biases aren't going into whatever you're writing. So you go, oh, okay, well, there's all these kinds of problems here, and then you go, oh, okay, maybe I need to, maybe this is fraud because I see these 3 little factors. Well, those factors are completely isolated from each other. They don't even really relate to it. And in some cases, you might even made a mistake because you were looking for the fraud
Mhm.
rather than just looking for what was there.
Mhm.
So just having that information period is really helpful to investors because they might have made mistakes before when they were deals. And that's one of the biggest things I see is people sometimes go, oh, this is a scam. And it's not a scam. It's just that in some cases, when organizations become more professional, like the syndicators stop acting like your best buddy and they treat it more like a business,
Yeah.
people don't always like that.
Uh-huh.
And they start to get a little bit distant and they go, ooh, is this guy committing fraud? It's like, well, probably not. He might just be more professionalizing his business to make it more approachable to institutional investors, which is what they expect. They institutional investors don't want you calling them every day with a little update on the property.
Yeah.
That's not something they want. If you do that to a family office, they're probably going to not invest with you again because you're annoying them. Uh,
I went to a third party due diligence conference recently to kind of get a sense of like what the institutional space relies on for third party due diligence. And I was actually pretty shocked. They're just providing the information and they cannot provide any sort of recommendation like, this
mhm.
company has these red flags and that means that they're not investable. But what they're doing with that endorsement saying that they've been checked is not that we're recommending this part. It's like, oh, we have a third party due diligence report, right? They're basically just saying, here's what we found. Here are
Mhm.
some of the things that were positives. Here were some of the things that were negative. Now you go take it and make that decision. Is that something that
Yep.
you have to educate your own clients on?
Yeah, that's exactly what I have to tell them because occasionally a client will ask me something like, "Hey, would you invest in this deal?" I'm like, "I can't tell you that. I literally cannot legally tell you whether or not I would invest in that deal because I'm not your financial advisor. If I went out and did all the huge effort to get all the licensing, I would 100% tell you that. But I don't have those licensings."
Yeah. Are you allowed to invest in deals if something came across your desk and you were like, "Wow, okay, I want a piece of this." Are you allowed to invest in that?
Um, no,
Okay.
it's not a law. It's internal ethics. So
Okay.
if I do due diligence on it, I'm not investing in the deal. Uh, it's just it's ethically murky, and if someone found out about it, it just blows your credibility. There's no
Okay.
reason to do it.
If you
Even if
saw
you
something. Oh, sorry.
even if you're going to make a ton of money off of it, it's not worth it. At the end of the day, you're eventually going to come across a deal that you didn't do due diligence on that you can use that knowledge and you go, oh, okay, I know the risk profile of this. It fits my risk profile. I
Mhm.
can invest it.
Would you be able to, like, recuse yourself if you saw something that was really, really good and you're like, "I actually don't want you to engage me on this because I might wanna do personal due diligence on it." Would that be something you'd consider?
I guess it would depend on the client. If it was like a one time, I might do that, but and honestly, it's not in my personality. I would probably
Yeah.
just be like, I'm going to help you out no matter what.
Yeah, because it sounds like you do work on, kind of like retainer or
Mhm.
an engagement letter of engagement basis, for several recurring clients.
Yeah, we have two models. One, it's designed for LPs. We are working on it a little bit right now, but it's basically if you have something, do like one deal a year. If you have something and you need someone to review it, we'll review it on that basis. We just review that one deal for you. We're not providing consistent support. We do active monitoring on all our deals, but that's just so if there's something like crazy, like a fraud case pops up, we can find it very quickly and inform you of it, or like
Mhm.
an adjacent fraud case, because occasionally we'll have not the main managing principal or anything, but like a GP on the team
Mhm.
get convicted of fraud. He doesn't really have a lot of control, but we want to let our client know about it.
Yeah. Okay.
Um, and then we have we call it a subscription model, but it has more in line with what a retainer model is. Essentially, we calculate how much support someone needs and we charge them based on that.
Okay.
Both are fixed pricing.
Okay. And I think this is an important conversation to have because understanding someone's revenue model, it shows, alignment or misalignment. I don't think enough investors ask the question to either their service providers or to the people that they're investing in, how are you making money on this? And so I like to just be very transparent about it upfront and just let people know what my motivations are in my revenue model in my business and my personal. I even maybe share a little bit too much about my personal finance because I want people to understand like where I'm coming from. I think that that question is incredibly important, but I don't know if it is because I don't hear a lot of other people talking about it, even in their sales cycle. It's like, here's how this business makes money. Here's how I make money from this business. And here's how you could determine if there's alignment or misalignment. And the big example I always hear is like, I don't need to save money on taxes. I'm a real estate professional.
Hmm.
That's like the best tax strategy out there. And so I'm not making investment decisions based on how it's going to save me money on my taxes. But some of my investors are much more interested in that. And so understanding that I don't care about the tax implications of this deal, um, it's not necessarily they couldn't invest with me if they're involved in that tax side, but that they need to ask me what my motivation is and my revenue model so they can understand if
Mm.
there's some sort of misalignment there. There possibly could be, depending on what they uncover. But you're talking about your revenue model in your business, and it's just really important. But before people even call you, to know like that this is a service that you could pay for, you have a couple different options, and you have a business behind it. And it's the same thing with the syndicator. What are they doing? So how does that factor into your due diligence? How's everybody making money? Seems like a big, important question to me.
Yes, that is one of the biggest questions. And not only do you want to know how they're making money, you want to know where they're spending money, where they're not spending money, and where they probably should be spending money and they're not.
Mhm. Yes.
um, for example,
Budget for things and their expense ratio looks amazing. You're like, well,
yeah, or you say they're like expense ratio looks amazing, and then you pull up county records and they have dozens of mechanics liens, or they have constant tenant complaints about poor maintenance, and you're like, that's where the good money went. Okay, gotcha. That's what we're doing here.
yeah, definitely.
Um, and it's like at the end of the day, that could be a viable business strategy. It's not one I would personally use, but it could be a good one. Uh,
It works for a
but
minute.
eventually, it's going to cause you problems. That's what seen when we've analyzed. Oh, probably last year we probably analyzed at least 100 separate syndications.
Mhm.
Um, and it's just little things like that. Over time, they tend to build up, and you're like, okay, I need to understand how this person's making money off this deal. And if you look at it in the entire way they make money is, oh, they charge a lot of fees. You might want to have some questions for them regarding those fees. It's like, well, are these performance-based fees, or are you just getting paid regardless of how many deals you do? So you're just going to constantly run deals into. Big issue in the syndication space right now is people just not understanding fees. There are some really great voices out there that are talking about them because they actually worked in the kind of institutional finance area and they understand the fees that like hedge funds, investment advisors, all these people are already charging. And in the syndication space, when everyone started switching to the fund to fund models and they started charging all these different fees, you're like, okay, let me get on my calculator and see how much money you're making on this deal.
Mhm. Yeah, and I think it's important to understand that. It's like, on the one hand, I want the partners to get paid well because I want their eye
Mhm.
on that ball. I do not want them to be like, "This deal is oh, it's just not even worth it." So, making sure that they're getting paid well for their active management is really important, but that not that they're getting paid so well that they also don't care. There's a sweet
Yeah.
spot in the middle of that. So, I could I could talk about this all day. You have a zillion stories. So, how do people get a hold of you? And I always ask, like, why should people get a hold of you? Like, what type of person would be best suited to be able to look into working with you?
Gotcha. One of the best ways to get a hold of me is probably LinkedIn. You can get in touch with me through our website as well. But if you get in touch with me through LinkedIn, I get an instant message to my phone. So it's very easy for me to just quickly pull it up and respond to whatever. We can set up time to meet, whatever we need to do. If you're too busy, I'll send you my email. We can work from there. Um, Basically, if you're investing money, you're involved in any high stakes deal, even like you use high stake vendors. Let's say you're a development company and you're spending hundreds of thousands of dollars on this particular vendor. That's a risk. We work in the risk management area. We do vendor risk as well. So basically, if a lot of money is changing hands and you want to research the counterparty, get in touch with me and we'll work together. If there is something I absolutely cannot do or will not do, I will let you know in the first 5 minutes of us talking. I will never go, oh yeah, I think I can do that.
Yeah.
Um, if
Awesome.
anything's ever on the fringe, if anything's ever on the fringe, I am the first one to do research on it. And I'm like, I don't know if I'm comfortable looking into that for you.
Mhm.
It's just because we want to make sure that every single time we're doing exactly what we say we're doing. Our company slogan's literally, we're here to help.
Okay. Perfect. Yeah. And that's AEGIS Risk Solutions and Investigations. AEGIS Risk RSI.com. But I found you on LinkedIn. You're super responsible over there and you post some incredible content that I really enjoy reading because I feel like the more I understand about doing due diligence, the more comfortable I feel because I have been pulling back on my own risk profile because of where we are in our retirement. And I find a lot of comfort knowing that, as we eventually will kind of push farther back into there, that I will feel better. Because there are some scams that we've narrowly avoided. I don't think I've talked about on this show before, some pretty big ones. And early on in our investing career, and I can't really identify what it was that made me say, "Well, I'm not gonna invest with this person." Right? A little bit of that scarcity mindset protected me, a little bit of that gut feeling, but there were some certain things going on. But as I'm looking back on it and I'm reading your stuff, I'm able to be like, "Oh, that's why I felt uncomfortable with this situation." And it wasn't just a gut feel. I can now put a name to it because sometimes we just don't know what to call the feeling that we have. So I found it to be very helpful in my own investing journey. And I'm just really happy that you came on to talk about it because this is just something that more people need to know they need to do, what it looks like, and where to go for help. And so thank you for coming on the show today.
No, thanks for having me.
Yeah. If you want to get a hold of me, easy investwithemma.com, go straight to my calendar. Um, and I'm happy to talk about whatever kind of investing topics that you want to talk about. It's a free call. And I will hopefully be able to hook you up with any of the vendors that we've had on the show that can help you through your journey. I mean, I'm not going to just make introductions willy nilly because that's my reputation at stake. But to be able to say like, if this person can help you, this is somebody that you could look into. Is kind of my thought there. So we'll be happy to talk to anybody. I feel like the purpose of this podcast is to connect with the guests after the show because it's 45 or no, 55 minutes. Sorry for keeping you longer. It's just one of those things where you can only learn so much by listening. And at a certain point, you have to just go in and do it. And the people that we have on the show are very, very accessible and you can get a hold of them and talk to them, hire them, all partner with them, all sorts of things. So definitely reach out to me and reach out to the guests because that's why we do the show. It's not so we can put like this ivory tower or this red velvet rope between you and me and the guests or something. It's to become more accessible to you and give you resources. So I hope that that's what you're getting out of the show, and I really appreciate you spending time on it, and because I recognize that you have a lot of things that you got to get done, and hopefully we're providing that value that you're looking for. So again, thank you so much, Shane, for coming on the show, and I appreciate all the listeners. And we will see you next week when we talk about another passive income adventure.